I am propose to deliver welcome address and opening remarks. First of all, I would like to thank ASSOCHAM for providing me this opportunity. And today's session chairman is Dr. Surjit Bhalla, former executive director, India International Monetary Fund. Sir, we are very thankful to you and welcome you in this form. And our co-panelists, Dr. Charan Singh, Sri Madhav Nair, Miss Upasana Bhardwaj, Sri Indranil Sen Gupta, Sri Abhig Barua, Sri Siddharth Sanyal, and Sri Arjun G. Nagarajan. All are the co-panelists. So we welcome you in this platform for giving your valuable time and join this session. So and moreover from ASSOCHAM, Sri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM. And of course, we welcome you all sitting here to attend this uh, seminar. And moreover, Dr. Rajesh Singh from ASSOCHAM and Kusagra from ASSOCHAM, we appreciate your efforts to organize all this seminar and this shadow monetary policy committee meeting discussion on monetary policy. So this forthcoming RBI monetary policy committee meeting will be held on from 3rd April to 5th April. And as we have seen in the past review of 8th February 2024 meeting, which were the last in the for the financial year 23-24, that repo rate remain the same 6.5%, which were consequently paused 6 times. Uh, Before that, it has been increased 250 basis points from May 22 to February 23. So after increasing 250 basis in 6 meetings, they kept pause in the next 6 meetings. So this will be first for the financial year 24-25 on 3rd April to 5th April 2024. So again, we are expecting RBI should pose the repo rate at 6.5%, and uh, we are expecting rate cuts should start from June or August meeting, and it should be three three to four cuts, can be 75 basis points to 1 rupee during the financial year. RBI actually, the Monetary Policy Committee meeting decides in their meeting uh, the financials on the various parameters of economic financials, uh, repo rate, reverse repo rate, liquidity, inflation, predict GDP. So I expect inflation, as it was discussed in the February 8th meeting, that the projected inflation should be 4.5% during this financial year 24-25. So moreover, and it has been given that the quarterly, the first quarter should remain at 5% inflation, and quarter two should be 4%, quarter three 4.6%, quarter four 4.7%. So on an average, it should remain 4.5%. So in view of that though RBI monetary policy uh, will keep their accommodative stance, withdrawal of accommodative stance, I think in this meeting also, and they can change to neutral, because economists are in the opinion that first they will change the stance and then they will reduce repo rate. So it may be possible in this meeting they should reduce their withdrawal of accommodative stance to neutral stance, and in subsequent meeting they can reduce interest rate by 25 basis point. So, moreover, economy, all indicators are good. GDP, 23-24 can be up to 7.5 to 8%, and the GDP in this financial year 24-25 can be 7.7% to 7.5% as predicted by various economists. So, um, I again, I'm of the opinion that interest rate should be paused this time, and stance can be changed from withdrawal of accommodative stance to neutral stance. Uh, Thanks very much. Thank you very much for giving me this opportunity, and I stop here and forwarding to Dr. Charan Singh for their comments and other speakers' comments. Thank you very much.
Thank you very much, Agrawalji. That's very good welcome, and also mentioning what the industry is expecting. So I understand from your talk that you are the industry and you are expecting a pause and a move to the neutral stance. Let me share my thoughts with you. And then I understand that Dr. Sujit Bala will probably join us in a short time from now. I'm in touch with him. And I also understand Mr. Madhav Nair, who was to join today, probably will not be able to join. So let me go straight, and then I'm going to invite my colleagues at the EGROW Shadow Monetary Policy. But before that, I thought I'll share my thoughts with you. As you know, that we have recently had data, very encouraging data on India's growth story, and we have in Q3 recorded 8.4% growth. This is much more than was expected. We have also seen that the country's GDP in real terms for 23-24 is projected at 172 lakh crore, which is a real high growth rate in real terms. And we are finding that the gross fixed capital formation for the year 23-24 as given by the government is in the range of 34%, which is higher than 33%. Exports are doing well. Imports are doing little higher than the last time. Exports are doing little less. Agriculture sector, there's a little worry because of the uncertainties in the weather and the El Nino effect. As far as manufacturing is concerned, expected to do very well. And construction activity and electricity production, they are doing very well. Now, as far as the quarter is concerned, Q3, I thought 8.4% was very good compared to 4.3%. So growth is picking up. But if you look at the current year, the growth has been in the range of, in the quarters, Q1, 2, 3, 8.2, 8.1, and 8.4. I thought that was a very robust growth. The growth in the quarter has also been very good in terms of construction, trade, hotels, financial sector, real estate. Gross fixed capital formation is April to December is 33.7, exports 22.5%, and imports 26.1%. Imports are a little higher, exports are a little lower. We know the global scenario is not very good. The high frequency indicators are showing private vehicles are doing well. The cargo handled at seaports and airports is also doing very well. So to that extent, there are interesting, positive shoots, I would say. As far as the core industries are concerned, almost all core industries have recorded very good growth, be it coal, steel, cement, natural gas, electricity, and crude oil. They have done a great job. And if you look at the combined core industry index, it's up by 3.6% over January 2023. And if you look at April to Jan, it's around 7.7% growth, which I thought is very good in coal and steel. And also, coal and steel is doing very well. If we look at IIP, the Industrial Production Index, Again, manufacturing is around 3.2% in January compared to 4.5, little low. Electricity is 5.6 to 12.7, and overall around 3.8. But if we look April to Jan, the performance on IEP is very, very good. Okay. Now, if we look at prices, they're pretty stable. CPI is in the range of 5.1. Core inflation is around 3. Food inflation is around 5.1. This is the February data. And if we look at WPI, as you know, WPI has been very tamed for a very long time now. As agriculture, I said, was little worrisome, there is an expectation that agriculture prices could go up. Even now, when we look at the overall prices, though the overall figure is 5.1 and agriculture is 8.7, vegetables, eggs, pulses, spices are the ones. So these are basically food items which are causing inflationary pressure. The fiscal performance has been very, very good. The GST collection has been in February 1.7 lakh crore, and it's 12.5% year on year, out of which 14% is domestic and around 9 is imports, the external sector. And if we look at April to February, the GST collection is around 18.4 lakh crore, I thought, which was a very good number. I would also like to mention that the Reserve Bank of India has recently come out with State of the Economy article in their March bulletin. They have used the dynamic stochastic general equilibrium model, and they have made a prediction for 24-25. Of course, we'll know what the RBI is going to predict on April 5. But according to the data which they have now given us with using that model, quarter 1, 2, 3, and 4 of the next year, they're projecting 8.1, 6.6, 8, and 7.1 respectively. That adds up to 7.4% for the next year. As far as inflation is concerned, again using the same model, the dynamic stochastic general equilibrium model, the DSG model as it's commonly called, the figures are again very, very benign. 4.7, 4.4, 4.3 are the quarterly data points, and the aggregate is 4.4% as far as CPI inflation is concerned. So that way, the economy, look at industrial production, look at prices, look at fiscal performance, is doing reasonably well. There's another thing I wanted to mention. If we look at the global scenario and how the rest of the world looking at us, we have recently had, just about 48 hours back, Morgan Stanley talking to us about our growth. And for 24-25, they were expecting 6.5, they've raised it to 6.8. For the current year, they are putting it at 7.9. And they have also said that the growth in India is far more balanced now because they're looking at narrowing of the rural-urban consumption and the private-public capital expenditure. So to that extent, the growth is percolating down everywhere. Their own expectation is inflation moderation, and they're expecting that there's going to be normalization of the supply chain. So that is something very positive, that not only the Reserve Bank, not only the projections made by statistical models, but globally, understanding is that the India's growth is going to be much higher. Looking at the data of Manrega, of course, it has gone a little high, but then that is because of the lower agriculture demand, and that is one of the reasons. The trade data has just been released, I think about 3 days back, and the trade data is also giving us a very good trend. Foreign exchange reserves are building up, and we are rising now to a grade. We have had incremental 6 billion, and we are now on a $642 billion as on March 15. I thought that was very good. FDI inflows in the month of January, are higher. We find it's 4.2 billion compared to 2 billion earlier. and the FPI is 12 billion compared to 4.6 billion, three times more. The overall, during the year, the net FDI inflow is now, of course, little lower. We all know about it. But I thought the recent trend was that it is picking up. The other market perception is that the investment is going to pick up substantially in the next few years. So therefore, overall, the economy, looking from various angles, is doing reasonably well. We all know that Japan has come out of the negative interest rate and come in the positive. So they're tightening their monetary policy just about a few hours back. And already mentioned by Agrawalji, the industry expert with us, that Fed Reserve, we all know, is waiting. And maybe they will start thinking in terms of the adjustment from June onwards. Given this analysis that I've just shared with you, my own feeling is that the country is passing through an election cycle. We're in the midst of elections. And at this point of time, though the Reserve Bank is thinking in terms of an annual monetary policy, they're going to share with us their detailed analysis of the economy. They're also going to tell us their projections as they, MPC is making it for the future. I've just told you the projections made in the RBI for the next year. My own feeling is at this point of time, it will be most appropriate to have a pause on the repo rate and continue with that repo rate. Of course, as I mentioned during my presentation, there is a doubt that agriculture prices may not stay as benign as they are now. But given overall picture, I think the economy is doing well. Investment is picking up. Current account deficit is 1.2% of GDP. Most of the countries are holding back and looking at what the scenario is. Must remember, America, as we complete our election cycle by June, America's election cycle will be at the peak. And of course, they are going to get into election cycle in September, October, and then November. So June, they have a window where they may like to reduce. And I'm not very sure whether they will exercise that because that economy is also recovering and not fully there as far as inflation is concerned. So I would rest my case that I would expect a pause and I would recommend a pause at the repo rate at this juncture. With this, I see Madhav Nair has yet not joined. Sujit Bhalla has also not joined. So then let me go straight to my colleagues and I would invite Mr. Indraneel Sen Gupta to please share his thoughts.
Yeah, thank you, sir. So we are looking at a pause in the coming policy and then looking at cuts from June, 100 basis points till June 2025. So, there is a bit of a dilemma I think the RBI faces. On the one hand, inflation is benign. Core inflation is actually now running at below 3%, which means the real policy rate is very, very high at almost 3% plus. If you take core inflation, it is even high if you take uh, the headline inflation at 4.9. The RBI itself is forecasting, headline inflation at 4.5. Now, we have seen for the last few months a strange situation where all over the world, or at least in the US and India, high growth is coexisting with high real rates. Now, this clearly cannot go on, and something must give. And it's quite possible that growth will slow. And if you follow GVA, growth did slow quite considerably in December, and the trends now are, also that of softer growth. Uh, so when you look at the that inflation, when you look at growth, I think both argue for RBI rate cuts. The problem now is the US. because in the US, the Fed has been talking of rate cuts again, saying that look, real rates are very high at 200 basis points. The argument was that look, if inflation is going up 0.3%, which is like 3.6% annualized, then you have a 200 basis point uh, real rate in a country whose potential growth rate is 1.8%. Now there is a question mark on US inflation itself, because for the last two readings, inflation came at 0.4%, which is like 5%, in which case you actually don't have any room to cut, and in fact there is actually a room to hike. So I think that monetary policy all over the world will wait for the next two CPI readings out of the US. So far, the Fed has said that these were due to one-off factors, but let us see how that is. Because if you look at the vote by the Fed, I think the last time there were 11 out of or 15, I think, of the voters who were in favor of cutting 75 basis points and more. 3 against cutting more than 50 basis points. The rest were in favor of cutting more than 75 basis points. This time, the vote was 9 to 10. 9 of the voters were in favor of cutting up to 50 basis points, and 10 voters were in favor of cutting 75 basis points plus. For the next year, actually, the thing flipped. That is, 10 voters said that one cut less, 9 voters said that, let's cut as much. So if one voter had switched, the Fed would have indicated 50 basis point cut this year rather than 75 basis points. And then we would have been a very different market and world. So let's wait and see what, the Fed US inflation brings for the next two readings, and then we'll get a sense of the Fed. So the RBI will have to probably also is looking at the Fed given the narrow differential. So we are in a peculiar case where domestic growth and inflation argue for quick rate cuts, whereas the Fed is holding back emerging market central banks all over the world. So this time we are looking at a pause.
અને હમણાં પાછો 3 વાગ્યા પછી 1 રૂપિયાવાળો ફૂલ 120 મેં જોયો
Literally.
Requesting everybody to please mute their mics, please. Sorry, Indranil. Sorry, please go ahead.
Yeah, no, I'm done.
Yeah, done. Indranil, this is very interesting. Means I've also been wondering, this is strange that I myself wonder with such a high rate interest, investment has picked up even in our country. And we have already surpassed the pre-COVID rate. So you're very right that growth is high, interest rates are high. Somebody has to give up fast. But this very relationship that has been continuing and the recovery taking is really very interesting. And one thing is probably because of the COVID and the tightness that everybody had suffered, and then the demand resurgence that happened, and therefore this phenomenon could happen, but it cannot happen for too long. Otherwise, it'll start showing repercussions. I don't know if you want to speak about the recessionary fears in the US and UK, or you want to hold it till we come in the second round.
I mean, you are in a situation where the US is left to be the only growth engine of the world right now, because Japan is, in sort of a recession. Europe is falling into recession. China growth has come down. So, so we have to wait and see how long the US can keep pulling the global growth engine at such high interest rates.
And the Brits are also may slip into
they're
recession.
now not that important, but
Yeah, true. But you're right. In Europe, it's already setting in.
yeah.
With that, let me move on to Madam Upasana Bhardwaj.
Good evening, everyone. Um, on the global side, I would concur with Indranil. I think, when we look at the entire macro picture, domestic plus global, the bigger shocks that seem to be appearing are more skewed on the global side. At this point, we are just at the cusp where, the Fed probably just about refrained from signaling that they would not go for 75 basis of rate cut, but a 50 basis of a rate cut. I think right now it was more just trying to avoid too much disruption right away and buying some time. I do believe that there will be only 50 basis probably of a rate cut and not 75, or maybe even lower depending on how the growth inflation scenario pans out going ahead. And that is the biggest risk that the markets are sitting with, because that's not something which they are prepared for. And I think in the next 2-3 months, we will get better clarity on that front, but that will also be a source of a fair amount of financial instability, probably across various markets. So I would be watching that out closely in terms of more about the persistence of inflation in the US, how that trajectory is panning out, because growth, like Indranil said, we are seeing, all sides is firing from anywhere and everywhere. So I think at this point, inflation in the US will be key to watch out for over the next few months in order to get a direction on, if not a hike, but a complete delay into 2025 of a rate easing cycle. And I think that is going to be the biggest cause for volatility. And moving on to domestic parameters, again, we should not look at just the GDP numbers, which have been extremely high and much higher than what anybody anticipated in the market. But the GVA numbers are much more subdued, but they are still strong nonetheless. So FY24, 6.9%, that will moderate going ahead. And like Dr. Singh, you mentioned about, investments and the real rates going high. I think we need to keep in mind that the investment cycle, or if you look at for India's GDP growth, investment growth has been surpassing the consumption growth for almost 5 to 6 quarters now, consistently. And this, the reason probably it has sustained is also because it is largely public sector led and not private sector led. The hope is going ahead that private sector will now be crowded in and we start seeing some traction there. But my fear is that if consumption continues to lag with such a big wide gap between investment and consumption, then there could be delays in the private sector capex revival that we are expecting. So that is one point which I would have to watch out for much more closely. But having said that, we are looking at GDP moderation to 6.6% next year compared to 7.6% this year. I think consumption is something which we'll have to be very wary on. So we have seen urban consumption hold very well until now, has been very supportive, with rural remaining on the sidelines. We are seeing a mixed patch of data on the rural consumption. Slight amount of improvement is visible clearly, but we'll have to see how this really pans out. I think one thing which could work in their favor is post the elections, food prices, which have been, I would say, capped, through supply side interventions by the government. We could see the shift in terms of trade in favor of agricultural economy once the lid is, off. Once we see that the government kind of lets market forces prevail. So that has two ramifications clearly. One, in terms of demand, we might see a shift in demand in favor of rural economy. But at the same time, it also comes with higher prices, food prices. So here is where the risk comes on the food side. Food prices have already been very volatile. And if we see a further leg up on the food prices post the elections, then that kind of creates more problem for why. See, we may argue about the core inflation being low right now, but the fact is for RBI, they will be monitoring the headline inflation as a whole. So food inflation, and secondly, now energy prices have also started inching higher. So while it is supply side, but nonetheless, the headline inflation will be at risk if this continues to persist going ahead. So I would say that growth is holding up firm. There are risks even then, I think 6.6% is a good growth going ahead in real terms. And inflation does have more upside risks. We have 4.5% next year. But just to mention that 4.5% is coming because of the second quarter being extremely favorable. We'll be probably seeing an average of 3.5% or so. If I exclude that quarter, then the other 3 quarters is averaging around 5% or above. So, it is just the favorable base effect which is letting the full year average come down to 4.5% from a 5.4%. So I still believe that RBI will be a little cautious on their last leg of disinflationary trends, which I think Fed has been talking about. RBI too in their minutes have talked enough about. So I think this is where I believe that they will not be in a hurry to act at all. So April is a clear pause. I think there is no doubt about that on the rates as well as the stance front. But when we approach the June policy, global actions or the Federal Reserve's actions are going to be key. So that is one important action which we'll have to watch out for. I don't see a Fed rate cut at all in June. If at all, it starts in July, but I would push that even further. My bias is for a much more later rate cutting cycle in the US, which also means it restricts RBI in India too. And we will not see any early rate cuts. So the earliest I see is October, but I would say the later, there are more chances that we shift that also to beyond October rate cuts. 50 basis of rate cut at the moment is our base case, but like I said, it could be even 25 in FY25 if globally situation turns out to be different. It could be rather not just 25. I'm saying it could be a complete delay in the rate easing cycle altogether. Having said that, on the stance front, I think it's something which we need to keep in mind that RBI has provided a soft signal. If we see the period between September mid to January, RBI had, tight liquidity conditions were prevailing and overnight rates were hovering towards MSF rates, 25 basis higher than the repo rate. And RBI's operating target framework suggests that overnight rates should be closer to the repo rate. So there was a stealth tightening of 25 basis, but from February onwards, RBI has been acting through continuous VRRs, much more frequent VRRs, and infusing liquidity to ensure that overnight rates have been settling closer to repo rates. And at the same time, we have seen liquidity conditions improve because government spending has been there. And at least till 15th of March, FX intervention related liquidity was also there. So we have seen liquidity conditions improve, which has also prompted RBI to manage the overnight rates closer to repo rate, even by using VRRs. So RBI has been fine-tuning the liquidity operations very closely by ensuring that rates are closer to 6.5% rather than a 6.75%, which used to be until January. So clearly there has been some softening in their stance compared to what it used to be till earlier in the year. So that is one thing which we need to acknowledge. And as a result, I think as we go towards the June policy or so, the chances of a stance change is very high to neutral. But again, having said that, it does not mean that immediately it needs to be followed with a rate cut. A neutral stance is just about reaching a fair level of GDP growth and inflation, wherein you might be acting on either direction, depending on which way the growth indicators and the inflation indicators suggest. So I think this is going to be important. Just to mention on the liquidity front, things have changed, like I said, in the last 1 month. And even going ahead, we are looking at liquidity conditions to remain quite benign and comfortable. So the next few months, and rather I would say 2 quarters, I do expect liquidity to be broadly in surplus. Frictionally here and there, we will see some tightness, but I think broadly we will see liquidity turn surplus, and that itself will keep financial conditions at least benign, even though repo rate will remain unchanged. Yeah, that's it from my end. Thank you.
I totally concede your arguments. Given the election cycle that we are in, the liquidity will have to be maintained in a very optimal manner, and tightness or too much of surplus would not be there. So I totally agree with your position that in a way the signaling in the last few weeks has happened very clearly. I also agree that food prices, the water levels in the reservoirs are very, very low. And anything happening to the monsoons could really impact food prices. And the volatility has been basically on vegetables and food prices, and our crop is standing there. So I agree there's vulnerability there. So I thank you for that analysis. And let me now move on. And one thought I'm going to come back to all of you who are from the market. Uh, it's very surprising to note that Indranil, yourself, we are talking now in terms of quantum leaps of rate adjustments. When I used to be young, and most of the time we thought 25 basis point was the best thing. But now you see the language in the papers, and you all are talking is in terms of 50 basis point or 75 basis point. So I wanted to come back to you and say, look, are we taking steps on a very steady foot that we are taking that big move? But let me first cover Siddharth and then Arjun, and then I'll come in the second round. Siddharth, can we have your thoughts, please?
Sure. Thank you very much, sir. I'll possibly try to take it forward from what Upasana just mentioned. She explained very well about her views on the inflation trajectory, about the liquidity scenario, and accordingly what the RBI might do in this particular policy and going ahead in the next few policies during the course of the year. I think the way we see, we are relatively more comfortable on the overall inflation outcome. While it's absolutely true that the food prices part has become a lot more volatile than earlier, and given the frequency of medium to relatively more significant weather events have gone up very significantly over the course of the recent years, very clearly on the agro prices part, food prices part, the certainty is relatively lower. Now, but interestingly, in that case, it's very difficult to have an assumption in either direction. So basically, my assumption on that particular front at this moment is generally benign kind of a scenario. No major spike in either direction, spike or fall in either direction that I am figuring in. In fact, at this moment, in the last month and a half, there had been a couple of forecasts from international agencies who are talking about a El Nino a La Nina kind of a situation or a possibility of that in this particular year, which we also need to keep in mind. And typically, more often than not, a La Nina kind of a situation is more favorable for India, has proven more favorable for Indian agriculture, and has helped keeping the prices benign more often than not compared to at least the other extreme. So I'd not go for a overtly negative assumption on the monsoon front just right now. But if I take that assumption, and which is a big if, we all understand that. The other factors on the inflation side that we need to take into account, that even though recently the IEA has revised the Brent crude prices up to closer to $90 a barrel and all, broadly commodity price forecasts are pretty benign in the global market. So as Indranil also explained very clearly earlier, that US is acting as some kind of a only growth engine in the world economy, and most other economies are languishing in a very significant way. So that's why the global demand part doesn't seem to be too strong. Generally, global commodity prices are remaining somewhat anchored, I would say. Also, what we get to see that if I look at the WPI number, that number continues to remain quite benign for a very, very long period of time. There is absolutely no sign of any major fiscal profligacy at any point of time in the recent past. And with that background, if I see how has been the liquidity injection part on the part of RBI, I think that is very, very interesting. The last 2 financial years, this financial year, we know data up to say the 15th of March. So if I see the reserve money growth in the that we have seen, the last 2 years we have seen reserve money growth in the vicinity of 6.5% to 7.5%, give or take an average of roughly 7%. Much lower compared to the usual reserve money growth of which is typically in the teens, if not in often in mid-teens. So compared to that, RBI had been very restrained, very conservative in terms of providing primary liquidity into the market. So if RBI's primary liquidity infusion is consistently low, WPI inflation is consistently very low, global commodity prices are generally anchored, there is no sign of any fiscal profligacy generally, and global supply chain bottlenecks are kind of debottlenecking. So overall, it looks like it's a pretty decent scenario for the inflation scenario, rather than we just don't know what the weather situation will pan out to be. And there might still be occasions that for a 2-3 month period, we might see some bit of spike in inflation because of food price and agro price pressures. But at the same time, we have seen in the recent past, towards the third quarter of the last calendar year, we have seen when inflation had been going up because of food prices spike and stuff like that, and RBI has decided very clearly to look through that, and had guided the market, has given very clear guidance about that. They are ready to ignore that temporary jump in inflation if the overall trajectory looks more benign or in a zone which is more comfortable with them. So broadly, long story short, generally at this moment, if I need to model and have some kind of a forecast for inflation, my number will be relatively benign, closer to the RBI's forecast of 4.5%. At this moment, then there is a very clear dilemma on the part of RBI, that on one hand, the US Fed is not cutting, or there is not too much of clarity when exactly they cut, how much they cut, and if they actually ignore cutting in the months of June, July, etc., then possibly they come significantly closer to their election cycle. I don't know how exactly that particular part will play out, or whether that will pose some additional challenges for them, or that will actually push them to start acting a little faster. So those aspects will need to be seen. In a situation like this, when the RBI rate cutting cycle is supposed to be a relatively shallow rate cutting cycle of 75 basis point to 100 basis point, an emerging market central bank will not be in a hurry to lead the cycle of the global biggies. Rather than that, it's much more desirable and much more prudent on their part to go a little slow in terms of to start the rate cut cycle whenever it happens. So my baseline scenario is that RBI is not cutting rates anytime before August 2024. This is the baseline scenario. My baseline scenario is that in this particular cycle, over a period of about 1 year, they will be cutting anywhere between 75 to 100 basis points. One particular point, however, we do think that there is merit in. I have seen that the communication that has come from RBI, where they have actually highlighted some concerns, I would tend to say some resistance in terms of changing their stance at this moment. My sense is that there is still merit at this moment to change the stance to, which will mean essentially neutral. I'd put it like this. In the last 2 years, from May 2022 onwards, when RBI shifted the stance to withdrawal of accommodation, for about the first 10 months, we had seen RBI hiking rates. After that, for about another next 10 to 12 months, we have seen RBI actively and significantly withdrawing liquidity from the market. Now, the expectation is that on the rate side, RBI will be moving sideways for some time. On the liquidity side, broadly, it will be seen that RBI will be moving sideways for some time. In fact, if at all, that we are actually entering into a phase where RBI might end up infusing some bit of liquidity over the course of the next few months, more from the net foreign asset side. Basically, we anticipate the upcoming year to be a year with very significant BOP surplus, maybe to the north of $50 billion, and in that case, RBI will will not really wait for the rupee to appreciate. They will possibly keep on utilizing this particular opportunity to absorb the dollar liquidity, build their dollar reserves further, and in the process, they might end up infusing rupee liquidity in the system. It's true that some amount of that might be counterbalanced from other actions, other liquidity actions of theirs. But overall, I don't see a situation where going back to the point on reserve money, the reserve money growth will possibly be somewhat higher this particular year, rather than being as conservative as in the single-digit growth rates, etc., that we have seen in the past 2 years. So we are, long story short, again, we are into a phase where at this moment, there is the rates and liquidity management operations both will be moving sideways with a bias eventually, not much deep into future. Maybe in the next 3 to 6 months, with the situation will it will be a scenario when RBI will possibly be infusing a liquidity a little more in the system, and RBI will be actively talking about or eventually deliver rate cuts. Very true that even though the RBI is waiting for the Fed to move, it's very true that if the inflation forecast of 4.5% that we are talking about, if it turns out to be true, that real interest rate will be 2%, which will be significantly higher than the comfort or for their comfort. Or we have not really dealt with that kind of a real interest rate level more often than not. So obviously they have to think about moving in that particular direction. And accordingly, my sense is that at least moving on to a neutral stance at this moment makes a lot of sense. On the rate action side, RBI has actually developed or built their transition brilliantly, much better than any other central bank in the world possibly today, in the sense that the last rate hike was in 2023 February. Even if they cut as early as in August, that means they are moving sideways for a period of good 18 months. On the liquidity side, in that case, why should the RBI be inclined to, from all of a sudden, not on the liquidity side, on the stance side, why from all of a sudden they will go in a knee-jerk fashion from withdrawal of accommodation to straight away to fresh accommodation? They should get into a phase of what maybe a relatively shorter duration, maybe for 6 months, maybe for less than that, but should go into a phase of where their stance is neutral, and then move to a stance which is fresh infusion of accommodation or liquidity, whichever way we call it. So overall, we do expect inflation to remain relatively benign. We do expect RBI to stay on hold at this moment. First cut not before August of 2024. We see merit in RBI moving into a stance which means neutral. We have seen the RBI communication having taken note of that. Despite that, I'm talking that there is merit in doing that. The last point I might just touch upon on the growth side. On the growth side, whatever had been the projection on the GDP front, from my side, I have last full year I had been consistently wrong in terms of projecting growth numbers which are significantly lower than eventually what the official numbers turned out to be. To some extent, I do think that given that I, to some extent, try to see it also from the prism of the bottom end of the pyramid, that is also possibly influencing me. The way I see that at this moment, that even though some of the consumption indicators, etc., I see a bit of an uptick, that uptick is not so much pronounced in the relatively weaker section of the population. That's why you see stronger uptick in durables rather than in staples. And that is a scenario which is not the typical Indian style of consumption growth, which is typically very granular, very stable, and that's why leading to a scenario or situation which leads to very strong and stable growth rate in overall GDP also. I think compared to that, this particular consumption growth and GDP growth is slightly more top heavy. And also all my previous commentators have very clearly indicated how the investment cycle has been driven more by public sector rather than by anyone else. So I'll stop here and happy to take questions at a later stage if there is one.
Thank you so much, Siddharth. My own thought is that the April, we are all predicting pause. By June, we are not sure reservoir levels, vegetables, not very sure. Then the monsoon sets in. The election results are out by first week of June, and the monetary policy is scheduled to be from June 5 to 7. August is the only time when we have a little window, and by the next one is October and then December. October policy will be in the thick because America would be in their election cycle. So I'm not very sure, and you could be right, that August could be the policy where some change may happen. It's better wait and watch what the
So
Americans
also,
do.
so, sir, just to add to this particular point of yours, if you see minutely the timing, the RBI policy will be announced on June 7th, and the US Fed decision will be announced on June 12th, where there has been a lot of uncertainty for a fairly long period of time. So whether RBI will be willing to take the quote unquote lead here and lead even the global biggies and at this juncture.
At least in the past, they have not. So I'm not sure whether they like to do it
and possibly prudently so.
Yeah, prudently. So totally agree with that. Okay, let's move on to our last speaker, and that is Mr. Arjun.
Good evening, and thanks a lot, Dr. Singh, for having me here. Always wonderful to listen to everybody's views on the policy. I'll keep it very brief. Just a couple of things. So, like a broken tape recorder, I think we've been talking about since March last year. We've been talking about how the RBI would be on an extended hawkish pause all through FY25. That sort of played out. And from, I think, December last year, we've been talking about how FY25, there's barely any rate cut cycle ahead. It's only a 50 to 75 basis points that we were talking about from December of last year. Now, given that growth continues to remain fairly strong and headline inflation in India, there isn't too much of a downward movement. Rather, there is continued stickiness that one can expect from a headline point of view. And also that the RBI will be extremely dependent on the Fed's rate cycle. Given all of this, I think there seems to be more pressure on the downside on rates in the sense of reducing the quantum from 50 to 75 basis points. I think we're looking at somewhere closer to around a 25 to 50 in FY25. The probability of that seems to be much higher. Because we don't really think the RBI will preempt the Fed, and the RBI rate cuts, if at all, to whatever quantum, will only lag the Fed to a fair degree. I think Ms. Upasana made a mention of this, rightly so. She was talking about how, from a Fed point of view, there is a little hesitancy given that their macros are fairly strong. Markets were pricing in 100 to 125 basis points of rate cuts from the Fed. That has come down to almost around at 70, just above a 75, in line with what the Fed themselves have been saying for a while now. There does seem to be some hesitancy from the Fed. And if you put this in context of rate cycles in the US ahead of elections, I don't think there's ever been any rate cut cycle in the US just before an election. So there seems to be at least some pressure there as well. So long story short, I think we continue to feel that the rate cut cycle in India is going to be fairly short. From 50 to 75 basis points, I think we are veering more towards 25 to 50 in FY25. Growth remains fairly strong. Inflation expected to continue to remain relatively sticky. So I think the RBI will resist the temptation to cut preemptively and also cut rates more than this quantum that we're talking about. There has been some relative stability in the rupee. But I think risks seem to be more on the upside for the rupee, given that there isn't too much of certainty on flows, though there is a positive phase of another couple of quarters when the JP Morgan bond inclusion narrative also starts coming through, and you've actually seen FII in debt seeing a fair bit of a pickup. I think the RBI will be using this as an opportunity to possibly loosen liquidity. So if at all anything on market rates, I think it should probably see some softness more through liquidity rather than anything to do with rates. So yeah, April policy, no change. I think well beyond June is going to be the RBI's rate cut, if at all, provided the Fed does somewhere around the rate cut start around June or so. I think I'll stop there. Thank you.
Thank you, Arjun. You know, the June monetary policy of RBI is little ahead of the US. And as you said, and I also feel, may not be possible to take the risk earlier. But I tell you, this is such uncertain times that so that I'm not sure what could happen. Let me quickly check. I think Mr. Madhav Nair has not joined. I think Surjit Bhalla. I think Dr. Surjit Bhalla has also not joined. No, they have not joined. It's already nearing 4 o'clock. Oh, it's already 4. So I would then request each of the members if they would like to respond to each other or to the query that I had about 75 basis or a 50 or a 25 basis. And the way this whole thing is now listening to each other, sort of mapping out maybe FY25 for the first rate cut. So I leave it to my panelists if they would like to come. Upasana or Indraneel. Yeah, Upasana.
Yeah, Dr. Singh, I just want to add, or rather just say a few lines. You did mention that, we're talking about big quantum of rate changes nowadays. In fact, I think, during this rate hike cycle, what we've seen is a very back-to-back rate hike cycle and a very deep one. But now, globally, the rate easing cycle is going to be very disjoint and a very shallow one. So, now it technically we should not call it a cycle, because I personally don't think there's going to be so much room for the central banks to ease on a consistent basis. So when we are saying, let's say, a 50 basis of a rate cut, I honestly don't think there's just going to be a back-to-back rate cut. So if we see a, whatever the timing is, I think, let's say my base case is an October rate cut. I'm not saying that in December policy we'll see a rate cut. It could be possibly in February. And similarly, if we see a June rate cut by the Fed by any chance, which I think, again, low probability, but then it doesn't mean that in July policy we'll see a rate cut by the Fed again. So it is going to be a much more shallower rate cut cycle. And we might not be in a position, because I think somewhere globally there are some disinflationary pressures also, but at the same time, there is some inherent inflationary pressures which are persisting for too long, and often on geopolitics is playing its part and not letting the overall supply side bottlenecks subside entirely. So I think that is something which we'll have to be wary on, and hence, inflation persisting to 2% may not be a new norm at all. We could be seeing relatively higher inflation in the developed economies for a longer period of time.
Thank you. Thank you, Madam Upasana. Siddharth, you want to add something?
I didn't think of adding something, but just now what Upasana said actually leads to a very interesting scenario that I agree with what she is saying. Now, if we enter into a medium-term phase where there is bigger and a possibility of slightly higher inflation in case of developed economies, and we tend to see that some of the developing countries like India, compared to what we used to see 10 year, 15 year back, we are seeing lower inflation. So the inflation differential actually is narrowing in a very significant way. The strength of the economy in terms of growth, capital flows, etc., are stronger. Also, there is a question mark about the supremacy of dollar on a medium-term basis. What will be the implications for the currency markets and for rupee actually leads to a very, very interesting situation. Not necessarily I have the courage to call for a stronger rupee straight away, but actually this is leading to a very, very interesting scenario going ahead, maybe for the next few years.
All right. Abhik, I can't see Abhik. I don't know if Mr. Abhik is here. I think Abhik has also not joined. Indranil, you sit on lots of analysis and data. Do you want to add something?
So I think two things. One is that rate cuts, we are talking in multiples of 25. So the 100 is not, or the 50 or 75 is not one shot. It's over a period of time. And
Okay.
the second, I think, is that uh, the tightness in liquidity will now go away for now, because we will enter slack season from next week. But somewhere the RBI will have to put in, more money in a much more systemic way next year, and balance that with rate cuts, provided the Fed does that. So I think right now there is no independent monetary policy anywhere in the world. Everyone is looking at what the Fed will or will not do.
I totally agree. And I tell you, this very interesting time, and once we are now analyzing it, two, three things come up so clearly. One is, as you said, is there an independent monetary policy for a country even of our size? Secondly, are we all moving together as a herd? There's the rate cuts and then the rate hikes. And as now Upasana has added, that rate cuts will be probably disjointed and not as a team unidirectional as happened during the rate hikes. And one thing which we all, at least I am now beginning to realize, that despite the intentions, there can be global compulsions, keeping in mind not the economics and the data, but the political cycle, which could be dictating the rate hike or the rate cut. In the midst of a cycle, with so much global uncertainty, I do not know, in the midst of a political cycle, will anybody venture to do a rate cut, be it India, be it America. So I would close here with this interesting observation that we all have discussed. I think, Dr. Rajesh, we have had an interesting discussion and we have exceeded the time. So
thank you, sir. Thank you so much. I request Mr. Vasudev Mukherjee, please deliver the formal vote of thanks.
Thank you, everyone. It's been quite interesting indeed. We will, of course, now compile these recommendations together. We will be talking to the RBI and we will be submitting our recommendations, and your inputs are helping us in forming those recommendations. So thank you to all of the panelists and the participants for being here with us. Thank you so much.
thank you, SHM. Thank you, Dr. Rajesh. Thanks to my
Thank you so much.
co-panelists from Shadow EGROW Monetary Policy.